You know, when you're first learning something, especially when it's a complex skill like trading, it's so easy to get demoralized and feel demotivated by looking at your progress and comparing it to people that have already made it. So with trading, when new traders start looking at really successful traders, these iconic figures that seem to know everything, they kind of think to themselves, well, they must have been born with that ability. There's no way that I can achieve what they've achieved. But that's obviously not the case, because everyone has to start somewhere. So to kick off this brand new week, where I hope that you're going to be making tons of great progress with your trading, I just wanted to give you a bit of a boost with a little motivational clip. This one is of Paul Tudor Jones in an interview at Goldman Sachs, talking about how he got started in his trading career.
Well, it's funny, I got to be a trader probably because when I was really young, I was a game fanatic. I played every single game that there was: Monopoly, Life, Parcheesi, poker. I used to play hours of solitaire. I just loved playing games. I had, by the time I graduated from college, I already had probably at least a master's in probabilistic theory. And so when I was in college, I had no idea what I wanted to do other than drink beer, and that I was extraordinarily good at. I think it was February of my senior year, the guy that I inherited the book from said to me, "Oh man, you got to try this soybean futures. I'm back and we're hedging up." They had a huge plantation at the time in Arkansas. We're hedging up our soybean crop, and this just makes football gambling just pale in comparison. And then literally that weekend, I read a story on a guy named Richard Dennis, who was the biggest local at the Board of Trade, and then he used to say that he did his best trading when he was hungover because there was no emotion. And I thought, this is starting to get close to what I'm culturally pretty good at. And I started out working as a broker, and back then it was great because 21 years old, they come in, you take the Series 7, it literally took 2 weeks to study and pass it, and then they hand you, back then they handed you, at least in the commodity division, E.F. Hutton, this gave me a book on technical analysis of stock trends by McGee and Edwards. Yep. He told me, read that. I read it. Go home, read it again. I read it. Go home, read it again. I read it. He goes, you're ready to trade. You're ready to open accounts. So I'd say within 4 weeks, I was trying to talk my parents' friends into opening accounts and let me trade. And at 21, it was literally hilarious. I enjoyed so much the interaction with all my customers. I've always been, I think, a sociable person, so I enjoyed that so much that we were making money and talking to them all the time. But then after a while, I realized I could do so much better if I just traded for myself. And I started doing that for myself, and I did really.
So you were successful from the start?
Pretty much. You know, I had 2 phenomenal learning periods where I lost everything. Like I had $10,000 and went down to zero. And then I made back like $20,000 and then went down to zero. And I remember...
Are you just using these low numbers so we can understand?
No. This is when you're 22 years of age and it's 1978 or 9. That's just, a gargantuan amount of money. And I remember my father coming to me on the 3rd time and said, "You've got to get in something safe like real estate."
Exactly. Lending.
I said, no, I'm going to stick with this. And the rest is history. But I guess the point was, it was so funny. I guess by 1980, I was doing pretty well. And in 1980, I thought, my father kept going, "You've got to do something respectable." So I applied to Harvard Business School and got in. And I was thinking, okay, I'm going to go up there, and what is this place going to teach me? I was probably making a couple of $1 million a year trading my own account, which was a fortune back then. And the weekend before I was supposed to go, I was loading up the U-Haul to drive to Boston and just said, this is crazy. They're not going to teach me anything about this, and this may disappear. And so I never went. And continued trading. The one thing about trading for yourself, I got so lonely. I really did. I was doing real well, but I was so lonely. And back then, the Cotton Exchange closed at 3. I'd go home I'd do all my charts and stuff, go home at 4:30, watch Star Trek, and that was kind of my life. It was not, it was financially fulfilling, but it was unfulfilling in every other way.
If you want to watch the full interview, the link to the video is in the description. Paul Tudor Jones is one of the most famous and recognizable traders in the world. His fund, Tudor Investment Corporation, has around $10 billion in assets under management, and Jones himself has an estimated net worth of nearly $5 billion. He shot to fame in the 80s when he successfully predicted the Black Monday crash of 1987, as shown in the classic documentary called Trader. Jones became a trailblazer in the area of global macro investing and was a big reason behind the meteoric rise of the hedge fund industry. This is his story. Paul Tudor Jones was born in Memphis, Tennessee on the 28th of September 1954. When he stayed in Memphis for his early education. His father ran a financial and legal trade paper which Jones would write articles for while he was at college, under the pseudonym Eagle Jones. It was at this time that he claims to have read an article about Richard Dennis, the successful commodities trader who famously trained the turtle traders. This article left a big impression on him. He's quoted as saying, "I thought that Dennis had the greatest job in the world." Paul eventually moved to Charlottesville to study economics at the University of Virginia. He graduated with his undergraduate degree in economics in 1976, as well as becoming the university amateur boxing champion in the welterweight division, an appropriate fact for a trader famed for not pulling any punches in the market a decade later. After finishing university, Jones went on to work at the New York Cotton Exchange. His uncle, Billy Donovant, was a successful cotton merchant, and Jones asked him to help him get his career started. As his uncle was involved in the cash side of the business, and Jones had his sights set on trading, he sent him to Eli Tullis, a cotton trader based in New Orleans, who offered Paul a job in New York as a floor clerk at the exchange. Although he was just a floor clerk, Jones says he spent a lot of his time doing analytical work too, watching the market to try to figure out what made it tick. After spending half a year in New York learning the craft, Jones returned to New Orleans to support Tullis with his trading. This is where Paul learned the ropes of how to make trading decisions and how to execute trades as a floor trader.
The first year I did nothing but get us coffee. I mean, I was learning by osmosis and stuff like that, but I was, I was a glorified secretary, which was fine because I was soaking in everything he did, every move that he made, every step that he took.
In 1980, 4 years after graduating from university, Paul decided to begin trading on his own. He became an independent floor trader at the New York Cotton Exchange, and a very successful one at that. From 1980 until 1984, he only experienced one single losing month. However, he claims that despite his success and all the money he was earning, he was incredibly bored. In fact, at one point, he had been accepted into Harvard Business School and was packed up and ready to go, until he reflected on the idea and realised he wouldn't learn the skills needed to be a trader. He decided it was crazy and stayed where he was instead. He continued trading until 1984, when he then decided, partly out of boredom and partly due to health concerns, that he would go into money management instead, launching the Tudor Futures Fund with $1.5 million under management. He says, "I was really bored because there wasn't the personal interaction. That was something that I craved, and having colleagues and being in a clean atmosphere, and that was when I started my fund. All through growing up, I'd been involved in team sports and fraternities, and in school I was involved in a whole variety of activities, all of which were team oriented, and when I was on my own, I was printing money every month, but I wasn't getting the psychic satisfaction from it." Tudor Investments has provided an average annual return of approximately 19% since the fund's inception. The fund has been phenomenally consistent. Tony Robbins, who works closely with him, claims that Jones has made money every year since they began working together 2 decades ago. However, his most successful and famous period came during the market crash in 1987. The 19th of October 1987 is known as Black Monday due to the crash of stock markets around the world, losing massive amounts of value in a very short space of time. The Dow Jones Industrial Average lost a fifth of its value. Paul Tudor Jones, along with his strategist Peter Borish, predicted the crash of Black Monday. He tripled his money by holding large short positions during that time. Predicting Black Monday gained Jones a lot of attention from investors, and he talks about his predictions in the documentary released in the same year, Trader. It was first aired on television, but since then Jones has attempted to buy all of the copies that are available, and even calls for it to be taken down from the internet and out of circulation. There are different speculations as to why this is, but one of them is that this documentary may give away too many of his trading secrets. However, it is still possible to find it online on certain websites. Jones is considered a global macro investor and trader. This means his decisions are based on a macroeconomic level. He focuses on the overall economic and political situations in countries. Jones will invest in any asset class, but prefers to make use of the futures market. He says, "I've always liked the futures market so much because you can generally get liquid and be in cash in literally the space of a few minutes." The Trader documentary shows that he uses a range of techniques for his trading, including the use of Elliott waves, which he specifically refers to when looking at the stock market rally. Although the phenomenal returns he makes and the figures he speaks about in the documentary would suggest that he's a big risk taker, Jones actually suggests otherwise. He says, "I think I am the most conservative investor on earth in the sense that I absolutely hate losing money. I'd say that my investment philosophy is that I don't take a lot of risk. I look for opportunities with tremendously skewed reward-risk opportunities. Don't ever let them get into your pocket. That means there's no reason to leverage substantially. There's no reason to take substantial amounts of financial risk ever, because you should always be able to find something where you can skew the reward-risk relationship so greatly in your favour that you can take a variety of small investments with great reward-risk opportunities that should give you minimum drawdown pain and maximum upside opportunities." This was also confirmed by Tony Robbins when talking about the success of Jones.
He risks for asymmetrical returns. In other words, most investors think you take huge risks if you're going to be a billionaire, huge risks to be really successful financially. The truth of the matter is these great investors do not take those huge risks. The vast majority do not. Asymmetrical risk reward means they try to do the least amount of risk possible with the most upside. He would look for investments where he didn't want to invest unless he believed if he invested $1, he could ultimately make 5 off that dollar, 5 to 1. Now, he knows he's going to be wrong lots of times. And so he knows if I risk $1 and I lose, I can risk another $1, I'm still going to be up 3, you follow? He could be wrong 4 times out of 5 and break even still.
In an interview in 2000, Jones also says, "You've got to look at good traders historically. If a trader can on average annually deliver 2 to 3 times their worst drawdown, then that's a very good track record, and I'd say that that's what I try to do. If I thought that for the funds that I managed that 10% would be the worst that I would tolerate in a given year, then hopefully I'd annualize 2 or 3 times that, and that's probably what I've done. Maybe a little below that in the 90s and a little above that in the 80s. As a global macro trader, which would include anyone that trades things like forex or bonds, it's always necessary to have a grasp on what is going on at a political or economic level, particularly if you're investing over the long term. This is also part of Jones's investment philosophy, as he praises the need for doing your research and constantly be wanting to learn more. The secret to being successful from a trading perspective is to have an undying and unquenchable thirst for information and knowledge, because I think there are certain situations where you can absolutely understand what motivates every buyer and seller and have a pretty good picture of what's going to happen, and it just requires an enormous amount of grunt work and dedication to finding all possible bits of information. It doesn't make any difference whether it's pork bellies or Yahoo. At the end of the day, it's all the same. You need to understand what factors you need to have at your disposal to develop a core competency to make a legitimate investment decision in that particular asset class.
Like right now, I'm watching the currencies, I'm watching crude, I'm watching stocks and bonds. They're all interrelated. You know, the whole world is simply nothing but a big flow chart for capital. And if I start getting hurt in, for instance, stocks or bonds, then I'm going to make a total portfolio adjustment just because of the fact I might not like the way the numbers are going over the course of the day.
The huge success and wealth that Jones has enjoyed has led him to having a heavy focus on philanthropy. He founded the Robin Hood Foundation in 1988, which helps to target poverty in New York. He's also very involved in education for underprivileged children and takes an active role in keeping them accountable for their success. However, he does like to enjoy his money as well. He actually owned his own islands, the PTJ Islands, which are shaped like his initials. And in 2015, he bought an estate in Florida worth $71 million, where he lives with his wife and 4 children. He says, "I have a great wife and 4 great kids now, and that would be my crowning achievement." So, that's the inspirational story of Paul Tudor Jones, one of the most successful traders of all time. So to finish it off, here are some key tips for traders that were taken from the Trader documentary and spoken by Paul himself.
Because, I mean, after a while, the size means nothing. You know, it's just, again, it gets back to the question of whether you're making 100% rate of return on $10,000 or $100 million. It doesn't make any difference, right? You know, if you complete 78% of your passes, it'd be nice if you're in the NFL, but if you're in college or high school or even elementary school, I'm sure the thrill is just as great. To do the job right requires, again, such an enormous amount of concentration that you've got to be able, it's physically and emotionally mandatory that, you know, that you find some time to relax, and you've got to be able to turn it off like that. There'll be times, though, when I get so incredibly excited about a trade or even a project that I'll wake up at 4 o'clock in the morning, there's no way in the hell I'm going back to sleep. I'll sit there and I'll trade in my dreams for 4 hours. Where you want to be is always in control, never wishing, always trading, and always, first and foremost, protecting your ass. And that's why most people lose money as individual investors or as traders, because of the fact they're not focusing on losing money. They need to focus on the money that they have at risk. How much capital is at risk in any single investment they have? If everyone spent 90% of their time on that, rather than 90% of their time on pie in the sky ideas about how much money they're going to make, then they'd be incredibly successful investors.
Right now, Paul could cash in and make several $1 million. But if he holds on for a few minutes more, he could do better. He could also do worse.
I want to sell it so bad I can't stand it. I've just been sitting here wanting to sell it all day, but I know the thing for me to do is just not to, another thing for me to do is just to sit back. In fact, I shouldn't even be talking to you or looking at the screen. I should try to I should go work out right now.
Yeah, I think that's what everybody else is doing. So.
What's nice about winning is not winning, but what that means is that not only have you done well to this point in time, but obviously whatever script you've got, that you have written for the ensuing week, 2 weeks, 2 months, 2 years, obviously it's a script that has a great deal of weight behind it, and the market's corroborating it. So today's gratifying, but what's exciting is the fact that we probably will know what's going to happen tomorrow, and conceivably we know what's going to happen in the next couple of weeks and months and years, and so you go home and sleep better.
If you like this video and would like to see more videos on the legends of trading, hit that thumbs up button, and don't you.